Good afternoon, everybody. We will give just a few more moments for others to jump in, and then we'll get started shortly. Well, good afternoon, everybody. My name is Aaron Mull, Executive Vice President here at iTValuations, and we'd like to welcome you to our webinar entitled the Top 5 Year-End Questions to Ask Your CPA. I'm joined today by iTValuations CPA Greg Northrop, who's also our Director of Tax and Finance, and Managing Partner of IT Tax Advisors, which he'll talk about a little bit later today. But Greg, great to have you in the webinar. Thanks for giving us your time today.
Not a problem. Thanks, Aaron, for having me.
Yeah, no problem. I think we have almost 30 people registered for the webinar today, and I know sometimes folks who register to get the transcript and the video sent to them afterwards. All these webinars, just so you know, live on our website 24/7, 365. So if you happen to miss a webinar, we typically do 1 to 2 a month. If you happen to miss one, you can always jump on itvaluations.com/webinars and access a growing library of webinars about all things M&A activity, tax, finance, accounting, lots of great topics there. So we're pretty excited to continue adding to that list. A couple quick housekeeping notes. I think if for those of you who have joined us before, you know that part of our tradition at iTValuations is to give away a gift card to a participant in the webinar who answers a trivia question correctly and does that first before other people do. And so today's trivia question is actually about the idea of Christmas and specifically Christmas movies. And so to win the Amazon gift card, you have to be the first person to correctly identify Greg's favorite Christmas movie. So to do that, you put in the chat, you put your name, and then you put the guess of the movie. If you're the first person to put your name and then the guess of Greg's favorite movie, we'll email you that gift card shortly after the webinar is over today. So we're not going to tell you the answer to that question, though, until the end of the webinar. We're trying to keep people engaged to the extent we can. So thanks for participating in that. A couple quick housekeeping items. We do have 2 webinars this month. Of course, today is our first one. The second one is actually on December 17th, so just a couple weeks out. We're going to look at M&A in 2024, a year in review, looking at the landscape. What happened in 2024 from an M&A perspective for IT services companies? What do we anticipate? Predictions sure to go wrong in 2025, right? Like, what do we think might happen? And Reed Warren will facilitate that conversation with one of our clients, Brian Miller, who is the CEO of Fusion Tech. Brian has been a longtime client of iTValuations, and at one point was, I think, thinking of selling, but pivoted, and I think used landscape data and other information to make that choice. And so grateful to have Brian join Reed. I think it'll be a dynamic conversation, and we'd invite you to join us on that webinar. We are going to be on the road. Actually, next week, we'll be at IT Nation Grow down in Tampa. Greg, are you going to be there?
I will.
Greg will be there. So if you can't get enough of Greg today, you'll have a chance next week to get a little overdose of Greg. We'll also be at the ConnectWise Evolve quarterly meetings if you're involved in those peer groups. Would love to see you February 3rd through 7th, both. That's in Houston. And then Evergreen, their Elevate event is in March in Austin. And one theme I'm seeing in these locations, they're all warmer than where I am right now, which is outside of Cincinnati, Ohio, where the wind chill is near 0. And so I guess winter is definitely upon us. But I already saw by the way, I saw a great guest on your favorite movie, Greg, which is sure to cause a little bit of drama. Someone said Die Hard. And of course, the question is whether that's even a Christmas movie or not. I don't know if that's the answer for you or not, but
I think it is.
Greg thinks it's a Christmas movie. So you may have won if you put that. We'll let you know here at the end of the webinar. All right, let's dig in. Top 5 year-end questions to ask your CPA. And what I would say is we're going to just show you the 5 questions that we've listed here, but it's possible that your questions may be different than these 5. And so the Q&A is enabled, and we've had a little bit of drama with Teams and the Q&A on the webinar platform before. So we'll see if it works. But if you have a question that you don't think is answered in these five, or you have maybe a follow-up question to one of these five, drop that in the chat. And if we have time at the end, we'd be happy to address those. And if we can't, I'll have Greg send you an email. So we'll talk about what is my projected federal and state tax liability? Do I qualify to pay pass-through entity tax in any states? And if so, what is the projected liability that I can pay by December 31st? An update on the beneficial ownership information reporting, which I think the update, Greg, is within the last 24 hours, right?
Yep.
So we'll have
Fresh off the press.
fresh off the press, which is funny because Greg and I were chatting. One of the, I guess, the impetus for this webinar was to actually address this number 3, right? We were going to spend quite a bit of time on this one, but some things even changed yesterday, which is why you have to have a CPA who is aware of and knows all the things related to these types of issues. What strategies exist to reduce my liability? Never something any business owner cares about, I don't think, right, Greg? And then
No,
are there any tax law changes that I should be aware of for either 2024 or as I look ahead for 2025? So let's dig into number 1. So Greg, why don't you start with how would you go about estimating tax liability and why is that important?
Yeah, there's a lot of people that will come to me in, March and April with their tax stuff, and then all of a sudden get upset or frustrated when I give them the bill of, hey, this is what you owe the IRS or respective states for different state tax compliance. And they're like, well, what could we have done differently? What can we change now? And the harsh reality is, tax compliance, tax reporting is a retroactive, basically submission of what happened in the past versus really trying to take advantage of what's available to you now. And so when we talk about understanding your projected tax liability, understanding it in advance of year end allows you time and flexibility to be proactive instead of reactive. And so now you actually get to make some changes here ahead of year end. And we'll talk, one of the other questions are what are some of those changes you can do. But really, when we're talking your projected tax liability, when we're estimating it, we want to try and aim high. You always want to be kind of cautious around, okay, worst case scenario, here's what that number could be. And another reason for this is as business owners, I'm sure you're going through your forecast and your budget analysis for 2025. Another component that you might also be doing is on the home front, doing a kind of a home front cash flow analysis and where is all of our cash going as a family. Thinking about budgeting as a family, budgeting with your new salary or distributions and whatnot. And so I think it's important to understand what that projected liability could be so that you can just plan accordingly and make sure that you have the appropriate cash flow to make those tax payments. And really, how is it estimated? This is where, again, you hopefully should be working with your CPA to estimate it, but the tax brackets are out there. If you have a pretty simple tax situation, you can kind of reasonably estimate based on looking at the tax brackets and understanding, how your income is taxed if it's all kind of ordinary income. But I do believe it's, the more and more you add to your tax profile through investments or real estate or other businesses, or you have a spouse that works or has a business, it's really important to just sit down and ask these questions of your advisor of what is my projected liability so that I can plan accordingly. One other thing to note with your liability is your estimated payment for Q4. A lot of people are like, well, it's just my safe harbor. It's my 110% of last year's liability. I already know what I'm going to pay. So why do I need to worry about what the balance is for the remainder of the year? It's important for, again, that whole cash flow planning piece. So even if you're safe harbored from a tax payment standpoint, it's still good to know where you're going to land, because you want to know, do I need to make another payment by April? Additionally, what if you had a worse year than you did last year? Do you really want to make a safe harbor payment of 110% of last year's tax when your income actually went down in the current year? So again, these are all reasons to be thoughtful and thinking about, does it make sense to understand my liability ahead of year end so I can make changes? Now, when it comes to tax payments, you technically have till January 15th to make a tax payment for federal purposes personally. Most of the people on this call, I'm sure, are flow-through entities that like an S corp or a partnership model for your business. So you personally, your Q4 estimate isn't due until January 15th. In most of the case, if you pay state tax, that state tax payment is also not due until January 15th. And we'll talk a little bit about state pass-through entity tax as one of our next questions. But on the topic of state taxes, this is also the appropriate time to sit down with your accountant and know what is my state nexus exposure. And what state nexus is, if you're not familiar, is do I have a tax filing requirement in a different state? And as a general rule of thumb, if you have employees in another state, you have a physical presence and therefore have nexus or a tax filing requirement. Another general rule is if you have sales to another state, you should at least look to see if you have economic nexus. Every state has a different economic nexus threshold, where you have to review what is that threshold in terms of number of sales to that state, and at which point you now have a filing requirement. But this is the time to look at those things so that you can potentially make a tax payment if needed and avoid any interest or penalties. There's a lot of states that give you a 1 year grace period to say, hey, if it's your first year filing, you don't owe interest and penalties. But if you engage in business in the state of Wisconsin, as an example, Wisconsin doesn't have such a forgiveness allowed to you. You owe interest and penalties on the full balance of your tax liability as if you knew January 1st, 2024, that you were going to have a tax liability in the state. So it's important to just ask the question now versus reacting in March.
Greg, would you say that's probably one of the biggest challenges as you work with clients? And maybe this is a good chance for you to share a little bit about your background in accounting as a CPA, and then what we're doing with IT tax advisors as well.
Yeah, honestly, state taxes are probably one of the biggest risk areas for companies because it's all too easy when you first start off your business to be like, I'm located in Minneapolis, Minnesota, so it's very easy when I set up a business to be like, I only do business in Minnesota, so I'm gonna file a Minnesota return, and I just do that on repeat. And my CPA then gets, you know, kind of used to that repetitive nature of we just file 100% of income is Minnesota based, and we don't actually take a look at to see is that still the case. And so there's a number of clients. My background is I worked in public accounting for nearly a decade, working with high net worth individuals, their small businesses, and private equity groups. And the number of times I'd get transitioned an account, family business, multi-million-dollar business, and they've been filing in the same state for the last 25 years, even though they're now transacting in 20 or 30 different states across the country. And when we do our state nexus tax exposure, they should have been filing in at least 10 to 15 of those.
Mhm.
And now all of a sudden, if that were to come up as part of, say, due diligence upon the sale of your company, or come up where the state ends up finding that out, now all of a sudden you have a potential risk exposure that needs to either be dealt with by yourself with your funds or be dealt with with using the funds at the deal closing table. So one quick story that when I first came to ITV 14 months ago, I got thrown right into a situation where a company we were helping sell had a issue come up with regards to state taxes, more specifically state sales tax. And that sales tax issue ended up creating a liability to the tune of almost $1 million that the buyer ended up putting in escrow. So instead of the seller getting $1.8 million of cash at close, they only got $800,000 because $1 million of it had to sit in the escrow account until the sales tax issue was resolved. So I bring up state income tax, but also state sales tax as things that you should really make sure you're always having your arms around every year. And this is always a great time of year to ask that question.
That's great insight, Greg. Thanks so much. Do I qualify? Number two, do I qualify to pay pass-through entity tax? Greg, maybe start with what is pass-through entity tax?
Yeah, so some of you may be familiar, maybe your CPA has explained it to you, or maybe you're, a tax code junkie yourself and are reading up on this. But pass-through entity tax was basically the various states across the country, their workaround for the $10,000 state tax cap on deductible state taxes on your federal tax return. That was enacted as part of the TCJA rules back in 2017. And so what this allows you to do is it allows your business to pay the state tax associated with the income from your business in that respective state. And thereby the business gets to deduct it as an ordinary deduction against your federal income and there is no $10,000 cap. So this is really beneficial when your state tax liability is in excess of 10 grand across any number of states, not just a particular state, but across all the state taxes that you pay in general. If your liability is in excess of 10 grand, then this is a to your benefit to file and pay. Now, one thing to note with pass-through entity tax is obviously you have to be a pass-through entity, S corp or partnership. So this doesn't apply to C corps. Um, and it's also on a cash basis. So why I bring that up is you have to make any pass-through entity tax payments that you want deductible for tax year 2024 by December 31st. And so that's where the, purpose of bringing this up now on December 5th is you actually still have time to go through that state nexus assessment that I brought up on the previous slide, and then sit down and identify which of those states allow pass-through entity tax, which we're up to now 36 different states across the country have enacted pass-through entity tax, which is a massive amount when 4 years ago there were zero. So the fact that now we've have that many states that are getting on board with this idea, that you're probably filing in a state that offers it if you are paying state income tax. And it really should be to your benefit to look into this, because if you're in the highest federal tax bracket, say 37%, you might be saving 37 cents on the dollar for every dollar of pass-through entity tax you pay. Now, it's not going to reduce your state liability. If anything, you're going to have to pay a higher amount of state tax when you make the payment, because pass-through entity tax is calculated at the highest marginal tax rate in that particular state. So for like myself in Minnesota, I'd be paying 9.85% pass-through entity tax on all of my income, even though I might not necessarily be in the 9.85% bracket because Minnesota has graduating brackets. That might not be an issue in certain states because certain states just have a flat rate across all income. So it's important to just ask the question to your CPA, make sure that you are filing where applicable, and just look at the benefits of potentially filing if you're not ahead of your end.
That's great information, Greg. Moving on to number 3, update on the beneficial ownership information reporting. Greg, what happened yesterday, and why is it important for those listening in to know about it?
Yeah, so when Aaron and I were discussing having this webinar, I was lamenting about everybody I talked to was not familiar with this whole beneficial ownership report information reporting law that was technically passed back in 2021, and it was future dated to then be actually enacted and take go into law in 2024, which basically calls for all companies under a certain, size. Basically, it's like, 50 million in revenue, which is almost every company that, we work with. They must now report who are their owners, and that reporting is done with the FinCEN, Financial Criminal Enforcement Network agency. So it's not with the IRS. And the penalties are criminal, where it's a $10,000 penalty if you miss a BOI report. And so this was a completely new concept, caught a lot of business owners off guard that it was even passed. And there was a lot of people that I was talking to, they're like, wow, my CPA hasn't told me, my attorney hasn't told me, I had no idea that this was even a thing. Well, just yesterday, a Texas federal judge ruled that the Corporate Transparency Act that was passed back in 2021 may actually be unconstitutional in terms of some of the requirements that it is making of business owners to report some of this beneficial ownership items and information to FinCEN, and that Congress doesn't actually have the ability to force business owners to report that type of information, and it would be kind of an infringement of freedoms. They're still working through all of that, but essentially because a federal judge ruled that it is unconstitutional, all business owners are not required to file the beneficial ownership information report at this time until that ruling is dealt with in the appellate courts. Now, we don't know if that ruling is going to stand. We don't know if that ruling is going to be overturned, but until that ruling has a ruling, it effectively is just at a standstill, and you are not required to file your BOI report if you have not done so yet. Now, I asked this last question on the slide here. What do I do? What do I do next? Like that, what does that mean for me? And what I would say is as a CPA, I operate under the laws and regulations that are in place at any particular time in which I am asked a question. So, as the law currently sits today, you as a business owner are not required to report your information to FinCEN under the BOI rules due to this law being suspended or the enactment of the law being suspended. That being said, if you have any ounce of worry around what happens if that ruling gets overruled and it's back in place, and I just don't want to have to worry about it, go ahead and file it. It's a super easy filing. Make sure you go to fincen.gov and just follow the steps on there. You can go ahead and voluntarily do it. I'm just merely presenting to you that that ruling has been suspended right now, and we won't know whether or not we are required to follow through with the reporting until it's dealt with in the appellate courts.
So, Greg, if that ruling were to go through as we thought it may up until yesterday,
Mhm.
how often does reporting need to happen? Is it just when ownership changes or just one time?
Yep, it's a one-time report, and then on an ongoing basis, it's only when ownership changes.
Okay. So you're saying if there is some worry about it right now and you're not concerned about the privacy pieces of it, there's no harm in doing it now. It's done, taken care of.
Correct. You can just get it
Okay.
done, so then you don't have to worry about it, even if the law does flip. You don't have to keep tabs on it, you know.
Okay. Yeah, that's really good information. Just a quick note, if you jumped on a little bit late and you wonder why there's random Christmas movies in the chat, that's because these individuals are guessing Greg's favorite Christmas movie. And the first one to do that will actually win an Amazon gift card, a $50 Amazon gift card, which could buy you a DVD or two, right? Do they still have DVDs? I'm not exactly
I
sure,
think they
but
do. I don't know.
yeah, maybe. I actually had to explain to my 13-year-olds last week like what a DVD was, So kind of funny how that all works out. All right,
Right.
let's go on to number four. What strategies exist to reduce my liability? And maybe, Greg, what approach should business owners really be considering here as we get to the end of the year?
Yeah, really, the bet when people always ask me how can I save money in taxes, the unfortunate but true answer is the only way you save money in taxes is you spend money. So that's kind of the harsh reality of it is you're getting taxed on your income or the net positive cash flow to you as an individual. So there's only a handful of strategies out there that you can kind of um, reduce your liability and do so in a manner where it's already maybe an expense you were going to do anyways, and you're just kind of accelerating that expense into this year to reduce your liability now and take that benefit now. So a couple of ideas I threw out on the screen here, and I'm also happy to answer any questions on this too if people have other ideas or specific situations, because this question is obviously unique to each individual and each individual tax situation. But the first one I throw out there is this idea of bunched giving or bunched charitable giving. This concept has been around for a while, where instead of doing, your annual giving to your or tithe, if you're tithing to a church or to, giving to different organizations, you actually do 5 years worth of gifting in one lump sum gift to a donor advised fund. And then within that donor advised fund, you actually spread out the payments to the organization or the nonprofit over that same 5 year period that you were going to pay them anyways. And so for those who are not familiar with a donor advised fund, it's essentially an investment fund held by an investment broker. You can talk to your financial advisor. They're probably familiar or even have those vehicles at their disposal. And effectively, that vehicle allows you to put the money in, get a charitable deduction for the entire amount that you put in, and then you're just required to pay out of it a certain amount every year until you basically dwindle the account down to nothing. And so it's a really nice vehicle to kind of maximize your tax deduction. This is a really good idea if you sell your company one day, and you have now this big windfall of money, or maybe you had just a really massive successful year, but next year's not going to be as successful. Go ahead and, do this large one-time gift, and now you kind of take care of your kind of giving and philanthropic desires over the next handful of years.
Hmm.
Equipment purchases are also a very common one. I'm sure you as MSP IT service company owners probably take advantage of this idea with some of your customers where you're doing some annual business reviews and come up with, hey, you need to get all brand new computers or new server or whatnot, and you see a lot of your customers buying that equipment right before year end in order to get that 179 deduction. And so this could be a really useful strategy even for your own business if there is any equipment or large items that you can purchase. Maybe you look at the company car if that's an option. But please be advised that there's a lot of different rules out there with regards to what qualifies for 179, what doesn't, what states conform to having Section 179 be a truly deductible at the state level versus not. There's also bonus depreciation out there, which as of right now is not as favorable. It's only a 60% deduction versus 100% like it used to be a couple years back. That is potentially subject to change here in 2025, but that's the law as it stands today. So it's important to just understand what are your options and what is the full deductible benefit from those options. And then the last one I throw out there, I was just talking with a company the other day where we were actually looking at this accrual versus cash analysis. They're a cash basis taxpayer. They're thinking about selling in 2025. And one of the things I brought up is sometimes selling your company as a cash basis taxpayer is not a great answer because when you do a transaction, almost every transaction is done on an accrual basis. When you think about net working capital, when you think about kind of just how the financials are reviewed and analyzed, as part of due diligence. And so what can happen is say you close your deal on July 1st of 2025, but you get received prepayments in June for services not yet rendered. Well, that cash for those prepayments as part of the deal is going to the buyer, but you as a cash basis taxpayer actually have to pay tax on all of those cash payments up front and ahead of the deal. And so depending on where your receivables land relative to those cash prepayments, you could potentially have a negative tax impact for selling your company as a cash basis taxpayer compared to what you actually received as part of that transaction. So um, where you can make this change is at year end, you can look at what your ending balance is on your accrual balance sheet versus cash, work with your CPA to do this review, but you can actually look at and make a one-time method change where if it's a net positive impact to you, you get to realize that entire positive benefit in 1 year. If it's a negative impact, you get to spread out that negative impact over 5 years. So it's just an idea to take a look at, and you actually have until you file your return to make this change. So this doesn't have to be done before year end, but you can at least start the conversation and look into it to see if that makes sense for you and your business.
Really good, Greg. Definitely a lot to consider there, for sure. As we get to number 5 here, are there any tax law changes that I should be aware of really as we head into 2024, 2025?
Yeah, so I listed off a handful of the law changes here just for 2024. Bonus depreciation, I already kind of mentioned, down to 60%. The top federal tax rate remained at 37%, but it's now starting at married filing joint income at 731 versus it was down to, I think it was in the 600s last year. So it's gone up quite a bit because of the inflationary increase. And then standard deduction went up $1,500 to 29,200 for married filing joint couples. And then the estate tax exclusion for those that are trying to do estate planning and worried about potentially that death tax upon their death, that went up roughly just under $1 million to 13,610,000. And so there really isn't massive tax law changes yet. What is important to note is, kind of the results of the election a month ago, in being that when the Trump administration was back in office previously, that's when the Tax Cuts and Jobs Act of 2017 was passed back on September 27th of 2017. And in that act, all the tax laws as they pertain to individuals were set to sunset on December 31st, 2025. So that's a year from now. And the reality is no matter who took office, whether it was we're going to have a all more blue government, more red government, or combination thereof, there was going to be a change to the tax code coming a year from now. Now, with the government kind of landing the way that it did in a little bit more red fashion, we can reasonably ascertain that the laws are not going to change too much, or if anything, they might actually change to be even more beneficial. Some of the proposals that the Trump administration have thrown out to date would actually make some of the laws that were passed back in 2017 even more favorable for business owners, more favorable for families, more favorable for the elderly, like with the removal of taxation on Social Security. So there's a lot potentially coming. What we saw back in 2017 was the Trump administration took office in January of 2017. By September, they had a new tax law passed, and it was enacted on a go-forward basis, not retroactive. I bring that point up as an important note that even though we're expecting tax law changes, it would more than likely be on a go-forward basis starting January 1st, 2026, just because with the old laws sunsetting as of December 31st, 2025, it would make logical sense to basically just have this nice pickup of here's the new laws starting on this date versus making any retroactive changes, specifically when it was your own party that passed the law changes to begin with. So why change something that you didn't deem broken in the first place? But rather institute something that would otherwise have had to revert back to the 2016 laws. So again, long-winded way of saying I don't believe anything is going to be changing for 2024 or even 2025, but it is a good thing to keep awareness of and be talking to your CPA about throughout 2025.
Right. That's great information, Greg. If you do have other questions on taxing, we do have a few more minutes, and so feel free to
Yeah.
drop those in the chat. A couple quick points here of closing before we get to Greg's favorite Christmas movie. If you haven't had a chance to register for our next webinar, December 17th, go ahead and do that. I've just dropped the link in the chat, and so you can click on that and sign up. Again, a complimentary webinar around insights from and strategies, what we learned from 2024 with Reed Warren and Brian Miller. Also, just a couple quick reminders about where we will be in the next couple months. Happy to see you in one more location in person, whether that be IT Nation Grow, ConnectWise, Evolve, Peer Groups, or the Evergreen Elevate event in March in Austin, Texas. And then I wanted to give Greg just a few minutes to talk a little bit about IT Tax Advisors and the work that he's doing. He's the managing partner of this firm. We've actually started this year. Greg, will you talk about the impetus behind starting and what you're seeing the market, how you're seeing the market respond?
Yeah, so after joining iTValuations, with my past life being in tax, I got brought into a lot of tax issues and transactions, a lot of tax conversations, even during the valuation process around what can we do to, mitigate taxes, what can we do to our tax structure. And what I was hearing most commonly from business owners of MSPs and IT service companies alike was that their CPA wasn't really bringing ideas to them anymore. Their CPA was a great tax return filer and preparer, but wasn't really that tax strategist or consultant or advisor that was really kind of bringing kind of ideas, outside the box ideas or new ideas to the table as their business has changed significantly since the last time they maybe had a conversation like that with them. And so the whole impetus of starting IT Tax Advisors was really to kind of provide an avenue or a business that really truly focuses on doing this for IT service companies where we already have an expertise from evaluation and M&A side, and now we can actually approach like advising from a tax standpoint with those lenses already in place that maybe other CPAs wouldn't have because other CPAs aren't necessarily thinking about that exit date on the horizon. They're just looking about making sure I do a good tax return to report the historical numbers or mitigate your liability, which are all great things, but depending on where you're at in your life cycle, it might make a lot of sense to just be aware of, do I have the right corporate structure in place? Do I have the right, compensation plans in place that should I be looking at equity compensation or, rollover equity as a way of, doing acquisitions? Is there anything that I'm not doing from a state tax exposure risk or a state sales tax risk that I should be looking into? And so we really just help kind of look at those issues in a little bit more depth to try and help identify anything that should be uncovered ahead of a transaction and really help you plan for that exit down the road. And so our model is a retainer model where you pay us monthly versus a billable hour model. So then effectively, if anything comes up in your business, you have access to myself and our team for all of your tax needs and advice all along the way.
Thanks, Greg. And a lot of our IT tax advisor clients are also taking advantage of our valuations as a service model, which really is a business transformation solution that really allows you to track value creation quarter over quarter, year over year, and then also know the levers to pull as you think about what your potential exit strategy is, or maybe what your long-term business goals are. And so, if you're interested in getting more information about that, you can scan the QR code with your phone, and happy to provide a demo of the software tool. A lot has been developed in the last year, and we continue to make enhancements to the model. And I think if you think about your most important asset as a business owner, it's likely your business. And so to know the value of that business and know what levers to pull to increase the value of that business, and to really set a goal for what's the number I'm trying to achieve, this tool can help provide the information and advice to get you there. So feel free to check that out. And then last but not least, the reason you're still here, I think, is to find out what Greg's favorite Christmas movie is. So Greg, give us the wrong answer. What is it?
Yeah, it probably is the wrong answer, but it's the one that every year I just sit down and watch with my family, and that is Elf.
All right, Elf is the winner. And so I think Ken had Elf. It was actually the first guess. So Ken, I'll be in
Yeah.
touch with information about that gift card. The correct answer, though, I think was actually given to us by Keith, who said It's a Wonderful Life, which I watched
Mm.
part of last night with my son. That movie, I think, was made in 1946. And so I had to do a lot of explaining about what he was looking at. He was like, "What's that thing?" I'm like, "Well, that's a phone." He didn't no idea. So, but yeah, it's a great time of year. We hope you all have a great holiday season. Thanks for joining us today. And if we can be of any help to you here at IT Valuations, please don't hesitate to reach out. Take care, everybody.
Thank you.